Have you ever felt like even though you've done everything right, everything you were told you had to do, something's still off? You work hard, you save diligently, you invest in safe retirement funds, you avoid debt like it's the plague. You've followed every rule in the mainstream playbook for getting ahead. But then you look out at the world, at the people who hold real power, the families whose wealth spans generations, and you can't help but wonder, are they playing the same game as the rest of us? Or do they have a different set of rules, a secret playbook no one ever shared with you? That nagging unease isn't random. It's creeping into the minds of so many people our age, those of us building careers and lives in the US or Canada. We see the cost of living skyrocketing, the dream of owning a home slipping further out of reach, and the wealth gap. It's not just widening, it's turning into a bottomless chasm. You're working longer hours, smarter hours, but your financial wheel seems to spin so slowly, sometimes even grinding backward. Is the system designed to keep us at a certain level? Are the financial tips we hear every day sensible, safe advice? Actually part of a larger mechanism, one that keeps power and wealth concentrated in the hands of a select few? Let's be real for a second. Advice like steer clear of bad debt, diversify your portfolio, invest long-term in the stock market, it's not wrong. It can help you build a stable life, maybe even a decent financial foundation. But is it the path to real power? Is it how the ultra-wealthy not only create wealth, but protect and multiply it across decades, through economic crashes, crises, even wars? I'm not here to tell you everything you know about money is a lie, but I want to invite you to explore a different perspective, one that might make you uncomfortable at first because it challenges the core beliefs we've been taught. What if I told you that some of the strategies the wealthiest people use to maintain their power revolve around things most of us are told to avoid at all costs? What if the assets labeled bad, risky, or not worth it are actually the sharpest tools in their financial arsenal? This isn't some conspiracy theory. It's about seeing how money really flows, how power is reinforced, and how the biggest players operate in a world where the rules seem written by them, for them. They don't just invest in stocks and bonds. They pour money into things far more complex, things that demand deep understanding, patience, and sometimes a calculated willingness to take risks most people wouldn't dare face. In this video, we're not chasing get-rich-quick schemes or pie-in-the-sky promises. We're going to pull back the curtain together, uncovering 5 assets or counterintuitive investment strategies the ultra-rich use, not just to get richer, but more importantly, to hold on to their power and influence. These are secrets you won't find in school, secrets rarely mentioned on mainstream financial news. Why? Maybe because if everyone understood them, the current order might start to shift. Are you ready to question what you thought you knew? Are you ready to peek into the darker, or rather, the other, side of building and keeping wealth? If the answer is yes, let's start this journey into the world of contrarian investing. What you're about to hear might change how you see money, investing, and your place in the global financial puzzle. Don't expect easy answers. Expect the truth, even if it's not always comfortable. The first secret we'll uncover is tied to something most people try to eliminate from their lives as fast as they can. Part 2. The 5 Secrets of Contrarian Investing. Here we go, diving into the most controversial secret first, the one we've been taught to avoid at all costs since we were kids. Secret number 1. Toxic debt. The elites leverage play ***. You heard that right. Debt. Not the soul-crushing credit card debt you're scrambling to pay off each month. Not the car loan tied to a depreciating asset. We're talking about a different kind of debt, the kind the ultra-rich treat as a tool, a powerful lever to amplify their wealth and influence. While the middle class is told to live debt-free, that it's the hallmark of financial freedom, the wealthiest people know that debt, when used strategically, is one of the fastest ways to control far more assets than they could with their own cash. What's the common mindset? Most people fear debt. Debt equals risk, interest payments, being tied down. Mainstream financial advice hammers home the need to minimize debt, especially bad debt, the kind that doesn't generate income. And that makes sense if your only goal is relative safety. But why is this thinking flawed from the perspective of those with real power? Because they don't see debt as a burden, they see it as a source of capital. They grasp the subtle but critical difference between consumer debt and investment debt. They're willing to borrow massive sums, not to buy fleeting luxuries, but to acquire assets that generate cash flow or appreciate over time, assets whose income or returns far outstrip the cost of interest. Think borrowing to buy an apartment building, a thriving business, or even to invest in private equity funds. They use other people's money, banks, investors, to control assets worth far more than their own capital. That's leverage. Here's the kicker. In places like the US and Canada, the interest on investment loans is often tax-deductible. That means the government is indirectly subsidizing their use of debt to build wealth. Meanwhile, regular folks taking out consumer loans get stuck with the full burden of interest, no tax breaks. The rich use debt to buy income-producing assets and get tax advantages. The poor and middle class use debt to buy things that lose value and pay full freight on taxes and interest. See the difference? It's not just about the money. It's about the structure, about how the system is rigged to favor those who know how to wield debt as a strategic weapon. They don't fear debt, they master it. That's a cornerstone of maintaining power, the ability to control assets way beyond your personal resources. So what's the alternative? I'm not saying go out and borrow recklessly. It's about shifting your mindset. Start learning to distinguish between good debt and bad debt through an investor's lens. Understand that controlled leverage, in areas you truly understand, can be a path to accelerating wealth, not just scraping by on savings. It takes knowledge, calculation, and a stomach for measured risk. Narrator. From using debt strategically, the elite often funnel that capital into another type of asset most people dismiss as too risky, too tedious, or just too boring. Secret number 2. Boring businesses, silent money machines, ***. When you picture where the rich invest, you might imagine flashy tech stocks, billion-dollar startups, or high-profile mergers. But the truth is, a huge chunk of their wealth and power comes from businesses that are, well, downright dull. Think companies providing essential services, manufacturing unglamorous products, or operating in old-school industries that rarely change. What's the common trap? Regular people are drawn to glitz. They want to invest in the next big thing, companies splashed across financial headlines. They dream of 10x, 100x returns in a year. Steady, traditional businesses with modest profits? They're written off as stodgy, low growth, not sexy enough. Why does this mindset miss the bigger picture? Because these boring businesses have qualities the ultra-rich prize. First, they often provide essential products or services with steady demand, no matter the economy. People still need plumbers, trash pickup, or basic industrial parts, whether the stock market's soaring or crashing. That creates predictable, reliable cash flow, something power players value deeply. Second, these industries often have barriers to entry, regulations, capital needs, or established networks that keep competition low compared to trendy tech sectors. Third, they're often undervalued precisely because they don't grab headlines, letting the rich buy them at bargain prices, optimize operations, and churn out massive cash quietly. Owning and controlling these businesses gives them real power. They're not just minority shareholders hoping for a stock price bump. They make strategic decisions, control cash flow, and build lasting business relationships. This is tangible power, far beyond owning a few digits on a trading app. They can reinvest profits, expand, or pull cash out at will. They're not at the mercy of short-term market mood swings. Compare that to just buying public stocks. Stocks are easier, more liquid, but you're a tiny cog with no control. You're at the mercy of the company's leadership and market whims. Owning boring businesses takes more effort and expertise, but the payoff is steady cash flow and absolute control. 2 keys to long-term power. The takeaway? Don't chase glamour. Look for value where others see boredom. Seek stable cash flow and lasting competitive edges, no matter how unsexy they seem. This knack for spotting value where others see risk or dullness gets even sharper when markets descend into chaos. Secret number 3. Crashing markets. Buying fear when others flee ***. Be greedy when others are fearful, and fearful when others are greedy. Warren Buffett's famous line isn't just savvy investing advice. It's a core philosophy that lets the wealthiest solidify their power in the most chaotic times. When financial markets crash, when headlines scream doom, when the crowd panics and sells everything, that's when the real power players make their move. What's the common reaction? When a crisis hits, human instinct is to run. People sell stocks, pull money from funds, hoard cash, or flock to safe assets. Fear of loss overrides logic. The media amplifies the panic. Watching their portfolios evaporate, people sell at rock-bottom prices to cut losses or save what's left. Why is this a fatal financial and psychological mistake? And why do the elite do the opposite? Because they know crises don't just bring risk, they create once-in-a-lifetime opportunities. When everyone sells in fear, the prices of high-quality assets, stocks of great companies, prime real estate, even solid businesses, plummet far below their true value. Those with cash on hand, usually because they managed money carefully during boom times, and the calm to analyze rationally step in and buy these gems at fire sale prices. This isn't just buy low, sell high. It's a massive wealth transfer from the emotionally weak and impatient to those with long-term vision and resilience. Every crisis, the 2008 financial meltdown, the dot-com bust, or major market corrections, sees the ultra-rich get richer, more powerful, because they're prepared to buy when blood's in the streets. They don't just buy stocks. They scoop up entire companies, distressed real estate, or struggling competitors. They're buying the future at a discount. Compare that to this safe move of holding cash during a crisis. Cash feels secure, but it earns nothing and loses value to inflation. Worse, it means missing the chance to buy undervalued assets that rebound and soar post-crisis. The lesson? Don't recklessly catch falling knives. Prepare. Keep some cash ready for these moments. Train yourself to stay calm, not get swept up in the herd. Learn to assess an asset's true value, independent of short-term market noise. When a crisis hits, it's a test of preparation and nerve, and those who pass gain serious ground. Buying cheap in a crisis often requires patience to wait for markets to recover. That same patience unlocks another asset class the rich love, one the crowd avoids because it feels too restrictive. Secret number 4. Illiquid treasures. The gamble of patience ***. In today's financial world, liquidity, the ability to turn an asset into cash quickly without losing value, is king. People love stocks because they can trade them in seconds. They hoard cash because it's the ultimate liquid asset. But the ultra-rich? They pour huge chunks of their wealth into the exact opposite, illiquid assets. Commercial real estate, private equity stakes, fine art, antiques, even timber plantations. What's the common fear? Regular investors shy away from assets that are hard to sell fast. They worry about tying up their money, being unable to access it when needed. They crave flexibility, the ability to react to market swings. Mainstream advice pushes liquid assets for easy portfolio management. Why is obsessing over liquidity a trap, and why do the powerful embrace this inflexibility? Because they know illiquid assets often come with an illiquidity premium. In other words, because they're harder to buy or sell, they tend to offer higher potential returns than similar but liquid assets. These markets are less efficient, with fewer players, creating opportunities for savvy investors with deep knowledge and negotiation skills to buy at great prices. Plus, holding illiquid assets forces a long-term mindset. You can't panic sell a commercial building or a private equity stake because the market dips for a day. This keeps them from making impulsive, emotional decisions and lets them focus on creating real value over years, even decades. For the ultra-rich, the goal isn't quick profits. It's preserving and growing wealth across generations. Illiquid assets, with their long-term growth potential and insulation from short-term crowd psychology, fit that perfectly. Think private equity funds. They buy entire companies, restructure them over 5 to 10 years, then sell, or take them public for massive profits. It takes big capital, expertise, and patience, things most individuals lack. Commercial real estate, art, or rare collectibles work the same way. They demand knowledge, networks, and a willingness to wait. Compare that to the liquid stock market. Stocks are accessible, but returns get diluted by competition, and you're vulnerable to short-term swings. Illiquid investments are tougher, requiring more capital and know-how, but they open doors to higher returns and a disciplined, long-term mindset. The takeaway? Liquidity isn't always king. Sometimes, inflexibility is the advantage if you've got the knowledge and patience to play it right. All these strategies, leveraging debt, betting on boring businesses, buying in crashes, holding illiquid assets, rest on one invisible asset that's the most valuable of all, and the one the ultra-rich use differently from everyone else. Secret number 5. Wasted time. The long game versus instant gratification ***. In a world obsessed with speed, instant results, and hacking life to get everything faster, time is often seen as the enemy, something to outrace. We want to get rich quick, retire early, win now. But for those who build and sustain financial power across generations, time isn't the enemy. It's their greatest ally. What's the common mindset? People are impatient. They jump from one investment strategy to another, chasing the hottest trends, hunting for quick wins. They sell great stocks because they're flat for a few months. They abandon a business plan because it's not paying off right away. They're obsessed with squeezing every second for short-term productivity, missing the power of steady compounding over the long haul. They see waiting as wasting time. Why is this short-term thinking such a barrier? And why do the elite play a completely different game? Because they know real wealth and power aren't built overnight. They're the result of smart decisions, consistently executed over years, decades. They harness the awesome force of compound interest, what Einstein supposedly called the eighth wonder of the world. They invest in assets, businesses, real estate, quality stocks, and let them grow, reinvesting profits to create a snowball of wealth that gets bigger and bigger. This long-term mindset isn't just for financial investments. They apply it to building networks, deepening expertise, and passing down wealth and values to the next generation. They think in decades, even centuries, not quarters or years. They wait patiently for the right opportunities, like buying cheap in a crisis. They hold illiquid assets for years to maximize returns. They know building a lasting business takes time. They don't see time as wasted when waiting. It's a critical ingredient in their strategy. Compare that to the all-or-nothing mentality or chasing quick profits. Those approaches might score a lucky win for a few, but they're high risk and rarely sustainable. Trading time for certainty and compounding growth feels slow at first, but it's the far more reliable path to real, lasting wealth and power. The lesson? Reframe time as an asset, a resource to invest wisely. Learn patience. Focus on long-term strategies over short-term gains. True power lies in seeing beyond tomorrow. Looking back at these 5 secrets, using debt as leverage, finding value in the mundane, acting against the crowd in crises, embracing illiquidity for bigger gains, and treating time as an ally, you might feel a bit uneasy, maybe even skeptical. These ideas fly in the face of so much safe financial advice. The rules we've been taught are the right way to a stable life. On their own, or applied carelessly, most of these strategies seem risky, even reckless. Debt can drown you. Boring businesses can fail. Buying in a crash can feel like catching a falling knife. Illiquid assets can trap your money when you need it most. And patience can be mistaken for stagnation. They look like missteps, until you realize this is how the game of power is really played by the savviest players. The truth is, the financial path most of us are on, safe, sensible, seems designed to keep us within certain limits. It lets us survive, maybe live comfortably, but it rarely leads to the kind of raw financial power or absolute freedom the ultra-rich command. Mainstream advice often skips the real goal, not just accumulating money, but sustaining and reinforcing power. The rich don't just want to get richer. They want to ensure the system stays tilted in their favor. These contrarian tools serve that purpose perfectly, precisely because they're beyond the understanding or risk tolerance of most people. But now you know. You've glimpsed a piece of that unpublished playbook. Just realizing there's another set of rules at play, that the bad assets or strategies might hold the key, puts you in a different league. You're ahead of 90% of people blindly following the standard financial script without questioning it. This doesn't mean you should rush out and take on massive debt or buy a rusty factory. Not at all. This knowledge isn't a call to reckless action. It's an invitation to think differently, to start questioning your own financial assumptions, to watch the world with sharper eyes, spotting the power dynamics driving the flow of money. Your next step isn't blind imitation, it's learning. Dig deeper into how investment debt works. Study sustainable business models, even the dull ones. Train your mind to handle market volatility. Explore alternative assets and their role. And above all, start thinking longer term. If these ideas sparked something in you, if they've challenged how you view money and power, that's already a huge leap. The journey to uncover financial truth is a long one, and it never stops. If you found value in this perspective, if you want to keep exploring the hidden truths of finance and ideas that push against the mainstream, consider subscribing to the channel. We're here to dive deeper together, not to peddle easy answers, but to ask the right questions. In the end, it's not just about how to make money. It's about how real power is claimed and sustained in this world. And more importantly, what will you do with that knowledge?